Picture the Marseille harbor. Some boats barely move, others toss wildly with the waves. The stock market is just like that sea. What if you could measure how much your investments are likely to be tossed by the market's waves? That's what beta does. Beta isn't about predicting the future, but about understanding how sensitive a stock is to the market's movements. Grasping beta lets you move from guessing to making informed, strategic investment decisions based on your own risk tolerance. By the end, you'll know what beta means, where to find it, and how to use it to build a portfolio that matches your goals. Imagine the market as a drummer, a skilled percussionist setting the beat for the entire financial world. The market's rhythm is a complex and ever-changing pattern, influenced by countless factors from economic indicators to global events. It's a pulse that dictates the overall direction and sentiment of the stock market. Each stock is a dancer on this grand stage. Some follow the rhythm closely, moving in perfect synchronization with the market's overall direction. These are the stocks that tend to mirror the market's performance, rising when the market rises and falling when it falls. They are reliable and predictable, offering a sense of stability in a dynamic environment. But others leap or lag, exhibiting a more independent and unpredictable behavior. These stocks might surge ahead even when the market is stagnant, or they might stubbornly resist a downward trend. They add an element of excitement and potential for outsized gains, but also come with a higher degree of risk. Beta measures how intensely your stock dances to the market's beat. It quantifies the relationship between a stock's price movements and the overall market's movements. It's a crucial metric for understanding a stock's risk profile and how it's likely to perform in different market conditions. Beta essentially tells you its volatility compared to the market. A beta of 1 indicates that the stock's price will move in perfect lockstep with the market. A beta greater than 1 suggests that the stock is more volatile than the market, while a beta less than 1 implies that it's less volatile. Systematic risk, also known as market risk, is the tide that moves all boats. It's the inherent risk associated with investing in the overall market, and it cannot be eliminated through diversification. This type of risk is driven by macroeconomic factors that affect all stocks to some extent. Beta tells you how your boat will ride those waves. Will it gently bob along with the tide, or will it be tossed around violently by the swells? Understanding a stock's beta allows you to anticipate its response to market fluctuations and adjust your portfolio accordingly. High beta stocks are like speedboats. They offer the potential for rapid acceleration and exhilarating gains, rising and falling dramatically. They are highly sensitive to market movements, amplifying both the upside and the downside. Low beta stocks are ferries. They provide a more stable and predictable ride, even in turbulent waters. Steadier, less dramatic. They are less susceptible to market swings, offering a buffer against volatility. Beta isn't about company quality. It doesn't reflect the underlying strength or profitability of a business. It's a statistical measure of how a stock's price moves with the market, regardless of the company's fundamentals. A well-managed company can still have a high beta if its stock price is highly correlated with the market. You can't diversify away systematic risk because it affects all assets to some degree. No matter how diversified your portfolio is, you'll still be exposed to the overall market's fluctuations, but you can choose how much of it you want by carefully selecting stocks with different betas. This allows you to tailor your portfolio's risk profile to your specific investment goals and risk tolerance. Understanding beta helps you build a portfolio that aligns with your comfort level and investment objectives, that matches your appetite for market-driven turbulence. Are you comfortable with the potential for significant price swings, or do you prefer a smoother, more predictable ride? It's your tool for aligning risk and return, allowing you to make informed decisions about the level of volatility you're willing to accept in exchange for potential gains. With your personal investment journey, by understanding beta, you can navigate the market's rhythm with greater confidence and build a portfolio that helps you achieve your financial goals. Let's delve into the concept of beta and what these numbers really signify in the world of finance. Beta is a crucial metric used to evaluate the risk associated with a particular stock or investment portfolio. It essentially measures the volatility or systematic risk of a security or a portfolio in comparison to the market as a whole. The market's beta, serving as the benchmark, is always 1.0. This is the baseline against which all other betas are measured. Now consider a stock with a beta of 1.0. This indicates that the stock's price tends to move in sync with the market. If the market goes up by 10%, this stock is also expected to rise by approximately 10%. Conversely, if the market declines by 5%, the stock is likely to follow suit with a similar 5% decrease. It mirrors the market's movements. But what happens when the beta is above 1? A beta above 1 signifies that the stock amplifies market moves, is more volatile than the market itself. This means it goes up more in rallies, offering potentially higher returns during bull markets. However, it also means it goes down more in crashes, exposing investors to greater losses during bear markets. The swings are more pronounced. High growth sectors like tech or discretionary spending areas like luxury stocks often exhibit betas greater than 1. These companies tend to be more sensitive to economic cycles and market sentiment. Conversely, what does a beta below 1 tell us? A stock with a beta below 1 indicates that the stock is steadier, less volatile than the overall market. It experiences less upward movement in booms, providing some protection during bull markets, and less downward movement in busts, offering a cushion during bear markets. It's a smoother ride. Companies in defensive sectors like utilities and consumer staples often fall into this category. These businesses provide essential goods and services that people need regardless of the economic climate. Now let's consider a beta near 0. This signifies that the stock moves independently of the market. Its price fluctuations are largely uncorrelated with broader market trends. This is a rare but possible scenario, often seen in companies with very specific or niche business models. What about a negative beta? Even rarer still. These stocks move opposite the market. When the market goes up, they tend to go down, and vice versa. Historically, gold sometimes behaves this way, particularly during times of economic uncertainty or crises, acting as a safe haven asset. It's important to remember that beta is backward-looking, calculated based on past price behavior. It analyzes how a stock has historically reacted to market movements. While it's not a guarantee of future performance, beta helps set expectations for future volatility and potential risk. By understanding and reading beta, you gain insight into how much a stock's fate is intertwined with the overall market's ups and downs. It reveals the degree of correlation. Beta provides a quick snapshot of risk, an essential tool for building a well-balanced and diversified portfolio that aligns with your risk tolerance and investment goals. It's a key piece of the puzzle in managing your investments effectively. Let's see beta in action with 3 French giants. LVMH, the luxury leader, has a beta above 1. Its fortunes soar in good times, but it falls harder in downturns. TotalEnergies, the energy titan, usually has a beta near 1, moving with the market, but sometimes buffered by oil price swings. Engie, a utility, has a beta well below 1, stable, defensive, and less volatile. Comparing these betas shows how each stock might behave in a market storm. Do you want high growth and high risk, steady market tracking, or defensive stability? Beta helps you decide. It's a powerful shortcut to understanding risk before you invest. Beta isn't just a risk number, it's central to the capital asset pricing model, or CAPM. CAPM says you should expect higher returns for taking on more market risk as measured by beta. The formula: expected return equals your risk-free rate, beta X, market return risk-free rate. A stock with beta 1.5 should offer 1.5 times the market's risk premium. CAPM helps you judge if a stock's expected return is fair for its risk. It's a disciplined way to connect risk and reward. Beta is the key. On Black Monday 1987, markets crashed worldwide. Systematic risk struck with full force. Diversification didn't help. Nearly every stock fell together. High beta portfolios suffered the most, amplifying the market's plunge. Low beta stocks still lost value, but less dramatically. The crash proved that managing your portfolio's overall beta is crucial for risk control. Beta isn't just theory, it's a measure of real financial pain or resilience in a crisis. Always know your portfolio's beta before the next storm hits. Where do you find beta? It's easy, no math degree required. Go to Yahoo Finance or Google Finance, search for your stock, and look for beta in the key statistics. You'll often see beta 5Y monthly, showing how it was calculated. Repeat for any stock: LVMH, TotalEnergies, Engie. Free sites are enough for most investors. Pros use advanced tools, but you don't need them to get started. The key is knowing where to look and how to use what you find. Finding beta for a stock or portfolio is just the initial step. It's like discovering a hidden clue in a financial puzzle. But the real challenge, and where the expertise truly shines, lies in how you interpret that clue. Interpreting the beta value, understanding its nuances, and placing it within a broader investment context is where the real skill lies. It's about transforming a single data point into actionable intelligence. One of the first things you should always check is the benchmark that was used to calculate the beta. This is absolutely crucial. A Stoxx beta calculated against the CAC 40, the French stock market index, may differ significantly from its beta against the Euro Stoxx 50, which represents 50 of the largest companies in the Eurozone. These benchmarks reflect different market dynamics, so the choice matters. It's also essential to carefully consider the time period over which the beta was calculated, as well as the frequency of the data points used. Are you looking at daily, weekly, or monthly data? While a 5-year period using monthly data is a common and generally reliable standard, relying on shorter periods can be misleading and paint an inaccurate picture of a stock's true volatility. The R-squared value is a critical statistic that tells you how much of a stock's price movement can be explained by the movement of the overall market benchmark. It essentially measures the correlation. A high R-squared value, generally above 0.7, indicates a strong correlation and suggests that the beta is a reliable measure of the stock's systematic risk. A low R-squared, on the other hand, means the beta may not be as meaningful. It's crucial to remember that beta is fundamentally a historical measure. It reflects how a stock has behaved in the past. Significant changes within a company, such as a major restructuring, a change in leadership, or a shift in business strategy, can dramatically shift its future risk profile, rendering the historical beta less relevant. Therefore, it's best practice to use beta as just one tool among a comprehensive suite of analytical tools when evaluating an investment. Always combine the beta with thorough fundamental research on the company, its financial health, its competitive landscape, and the overall industry in which it operates. Beta provides you with a valuable snapshot of a stock's relative risk compared to the market. However, understanding the broader context surrounding that risk is what truly makes the beta a meaningful and actionable piece of information. Always read and interpret beta critically, questioning its assumptions and limitations. By doing so, you'll be well equipped to make smarter, more informed, and ultimately more successful investment choices. We started by asking if you could measure a stock's heartbeat, and now you can. Beta lets you see how your investments move with the market, helping you build a portfolio by design, not by chance. From French icons to financial theory, you've learned how to find, interpret, and use beta to match your risk and goals. It won't eliminate risk, but it gives you a vital edge in navigating market ups and downs. Master beta, and you'll steer your financial journey with greater skill and confidence.